Okay, happy weekend to you. All right, moving forward for my channel, Growing Your Tree of Prosperity, I will be experimenting with a different mix of topics. All right, so for the folks who traditionally enjoy my discussions about investing, you can expect a slight pivot in the content. And the main reason is because I should be expecting a payout in October. So money is coming, the monetization of the channel has succeeded. So in the process, I would like to do some experimentation to see what other kinds of content that you like. Now, I am aware that the folks listening to me, you like discussions in dividends investing, CPF, how to become a millionaire, right? And these are the traditional topics that I do well in, right? But the truth is that this is a very narrow range of topics. So I need to do a little bit more experimentation to figure out what you guys like. So in the comment section, maybe you can just openly let me know what kind of material you like to hear about. Okay. So today I'm going to do something that is a little bit different. I'm going to talk a little bit about what I don't like to do. Okay. And I'm going to talk a little bit about my beef against covered call strategies. Okay. And uh, and what is a covered call strategy? Okay, a covered call strategy is that you own a stock and you are the typical investor like me, you love your dividends, all right? So you own a stock, but you want to boost your dividends, right? You want to find a way to get more money, more bang for your buck. So what you do is you go to your broker and you say, I write or I sell a call option to another party, okay? A call option is like a derivative instrument. And what it does is that when you do something to another party, you get money immediately. So money goes into your pocket straight away. All right. Now, what happens now after you sell a call option is that an option has a strike price. In other words, if the stock goes above a particular value, like the strike price, then you are then obligated to sell your stock at the strike price, all right, so that you're not able to get the upside of your investment. Okay, yeah, because the other person who buys a call option, he gets paid when the stock price exceeds a certain strike price, okay, which you will have to compensate to the other party. Okay, so it's actually very different from getting a dividend because you have some kind of a liability to the counterparty of the call option. All right. And the net effect of it is that you cap you cap the upside of your investment. All right, which means that if the stock rises above a certain price, you can no longer benefit from that upside. Okay. Now, it is very tempting to say, actually, I don't really care about capital gains. I just want my dividends to come in, right? So why don't I sell lots of these call options and I can boost the interest rate that I get. So a lot of investors like that, especially maybe the older investors, the more conservative investors in their 40s or 50s, they like that. Okay, now do note that it's difficult to execute in Singapore because we don't have the market depth for us to find a menu of call options to sell, right, corresponding to a local stock. Like for example, I own venture. I want to sell call options on venture. It might be slightly harder to do that. I'm not sure if your broker does that. I obviously don't have the courage to do something like this. But I would think that it would be difficult to find, for example, and sell call options on a stock like Takaro, UMS, or some of the mid-cap counters that we are playing. Okay, so this is something that you can't do in Singapore, but people love doing it in the US. All right, and there are many people touting these covered call strategies. Okay, so I hope I've managed to explain what a covered call strategy is. If it is not sufficient, I'm sure you can find a video somewhere else on YouTube that's able to do the job. Okay, so should high yield investors automatically love these covered call strategies? Okay, so I can't ignore the fact that if you were to sell call options at regular intervals, you can increase your effective dividend yields. All right. Now, provided these call options expire worthless, you will end up with a stable portfolio with a higher financially engineered kind of dividend payout. All right. So what's my beef over this strategy? What makes me unhappy, and why am I not adopting this for myself? Okay. And so I'm just listing out some of the problems I have with this strategy. Okay. Um, there is a possibility that these call options will go into the money. In other words, the stock goes up so much that it hits the strike price of these call options, and then you lose the ability to benefit from the upside. All right, so that's the first thing I don't like. Okay, I don't want to lose the upside, right? When we buy stocks for the dividends, we still want capital gains, right? I think that is the main issue. Okay. Now, secondly, the pricing of these call options is complex. All right, it is based on an equation known as the Black-Scholes model. Very, very difficult to understand for laypersons. Okay, but generally speaking, the value of these call options increase when the underlying stock volatility increase. Okay, and there are many options traders, the dubious ones in the 2000s. They have all these trading courses on the option Greeks. Okay, you need to make sure you understand the option Greeks. Like what's a delta, what's a theta, right? Before you could really be considered good, at dealing with options. Okay. All right. The another beef is that the brokerage fees eventually will add up and it will hurt you very badly. Okay, because options expire. So a strategy that buys an option that covers every quarter, you need to renew your options 4 times a year. All right, so that's one of the problems with the option strategy. And a full service broker can charge $100 for an options contract. Okay. Now I've done some research. Apparently, some discount brokers, they say it's 65 cents per contract. But do note that these options only cover 100 underlying shares. So if you have 10,000 underlying shares, then you'll be paying $65 for every contract or options that you want to apply to the covered call strategy. Okay, so discount brokers make, I would presume, a lot more money on options than if you were to buy the underlying stock. Okay, and finally, my biggest beef. Options trading is a zero-sum game, right? When you write an option to someone, there is always someone taking the opposite position from you. And so it is mathematically impossible for you to both make money at the same time, right? In fact, both of you will incur brokerage. So there is a possibility of both of you losing money at the same time. All right. Yeah. And so the final question you want to ask yourself, if you're a dividends investor, is why do I want to cap my upside, right? The whole point about investing is I'm going to make money from my dividends, and when my stock price goes up to a certain level, I sell it and I earn a profit. Okay? Okay, now, to make it more convincing, what I will do now is I will do a comparison, right? I will compare a option strategy, a ETF with a covered call strategy, and the Standards and Poor 500. So the equivalent of the Standards and Poor 500 with a covered call strategy is an ETF called JEPI. JP Morgan Equity Premium Income ETF. Okay. Now, both invest in the Standards and Poor 500, but JEPI overlays it with a covered call strategy. Okay. And so if you look at JEPI, it's a very attractive ETF because it's got a dividend yield of 8.42%. All right. Now, Singapore investors do take note. There is a 30% withholding taxes on dividends, but it should be lower than 30% because when you make money from a covered call strategy, tax authorities may not classify it as a dividend. It may be classified as maybe a short-term capital gain. All right. It's very complicated. Consult an expert on this. I'm definitely not an expert on this. Okay. So if we backtest this over the past 10 years, this is what we find. When it comes to returns, the covered call strategy is poorer than just getting the Standard & Poor 500, okay, by about 3%, okay. But what makes it attractive to a lot of older investors and more stable investors is that it's able to achieve 13% with a lower risk. The standard deviation is 11.1%, and hence you get a very high Sharpe ratio, and you also get a very low drawdown, right? The worst case scenario, 13.71%. Whereas if you hold the Standard & Poor index, your return can be 3% higher, but you might have to deal with larger losses at specific parts of the market cycle. Okay, so there is a reason why people like these covered call strategies, but when you overlay a covered call on top, you overlay a writing a call option on top of a stock, right? You are definitely sacrificing future capital gains, right, for slightly higher dividend yield. And this amount of dividend yield that you're receiving is normally lower than the capital gains that you have sacrificed. And the reason is because stock markets, right, goes up most of the time. And that's the reason why I have a serious issue when people tell me that, you know, I'm writing covered calls, I'm feeling so rich and I'm feeling so wealthy, right? And some experts even recommend that, look, if you like doing this so much, why don't you just add some bonds into your equity portfolio and not use derivatives to try to financially engineer these results, right? Okay, so here are some of my opinions on the covered call strategies. Options premiums are there to compensate the investor for limiting the upside of their investments, all right? But dividend investors still require capital gains to do well. Okay, you can't just say I'm happy in my dividends and ignore the idea of capital gains. Okay, I mean that's not how we work. All right. Okay. It complicates the strategy greatly as future volatility can impact the value of an option. Right. So you're often short a call option. So your plan succeeds when volatility of the underlying stock drops. But if the volatility of the underlying stocks were to gain, that means it becomes very choppy, right? It might not go well for you. Okay? Okay. Now, brokerage fees are also going to be higher than building a straight dividends paying portfolio because you're actually buying two products rather than one, right? So you're definitely paying more to the broker. And that's why brokers love these options trading strategies, right? They really want you to do this. Taxation is going to be complex because some jurisdictions, unlike Singapore, they consider dividends a certain kind of way you're making money, and they have short-term capital gains and long-term capital gains, and they apply a different rate to each of these different categories. Okay, so that might complicate your tax planning if you're going with this covered call strategy, right? And if you want to lower the risk of your portfolio, rather than, you know, buying a covered call option, you know, if you're in Singapore, you know, maybe you can just put a small allocation into your cash, your CPF, or your or your savers bonds, right? Singapore savers bonds or SSBs. It might be a better way of getting the risk return kind of profile that you want. Okay. And finally, if you really insist on the covered call strategy, you like the numbers I show you just now, then by all means just buy something like JEPI, okay, which is safer than any bespoke strategy. As the economies of scale, right, they are running an ETF, they can get discounts from their brokers. Everything becomes cheaper and a lot more transparent. Okay, so you can consider that strategy if you like it very much. Okay, and that's all I have for you this week. Now I'm going to slow down next week with my content, so you're not getting the usual 3 videos, because the truth is I'm a little bit burned out trying to get into the AIAP and then studying for my ACLP, getting tenants into my shop houses, my mom's flat. You know, yeah, it feels some sort of like a full-time job on top of it if you have to generate videos. Okay, but I do have some interesting content that's coming up, and I might spend a week giving content that strays away from what I originally provide for you, Okay, I'm always looking for new content and a way to refresh the channel. But hopefully within the next 1 or 2 weeks, I should be able to launch the second mini course on the channel, right? I'm trying to launch a mini course on the journey to become a millionaire, and I've decided to launch it for free. I'm not putting it behind the paywall. Okay. All right. So if you like my content, you subscribe to this channel. And I continue to do previews under Dr. Wealth. Google ERM intro, you take the first link and you can listen to me about my story about fire. Okay. And I hope to see you very soon. Okay. Yeah. But let me just take a short little break. Okay. And I'll see you after this. Thank you very much.